Hey, Dan Passarelli here. I was looking at the broad market today, the S&P 500, specifically the Spiders, SPY, and I see that Spiders made a new all-time high today. The market's higher than it's ever been if we use the S&P 500 as a benchmark. Now, this is very conducive to what I said in a video a couple of weeks ago, expecting some more movement to the upside in the S&P 500. And I think there's still the potential to move higher. But that said, me being long the market in my IRA and even in my trading accounts, I like the idea of protecting myself if I'm wrong or if there is a little bit of a pullback. And so I was looking at what I might be able to do to hedge. If you look at the VIX, that's the VIX, CBOE Volatility Index, you might notice that every time the S&P 500 goes down, especially if it goes down sharply, what we tend to see are some of these spikes in the VIX where it rises quite a bit pretty sharply, and a lot of times it's only up there for a couple or a few days, but we get these bigger spikes. And so what a lot of people will do is they'll use VIX calls to hedge their position in the S&P 500. And so that's what I'm looking to do. Now, I want to be really clear about something. This doesn't mean that I think the market's going to crash. This doesn't mean that I'm bearish. I'm still optimistic. But there's a saying when it comes to hedging, and that is buy them when you can, not when you have to. With the VIX at a very low level, and with the VIX options pretty cheap because the implied volatility of VIX options is low. So the volatility of volatility is low. It's not a bad time to position for a longer term hedge. I hope that helps. Trade well. This is Dan Passarelli.